So it's been a pretty volatile past couple of weeks. We're going to unpack what's happening in the region. But first, let's start with a global perspective, because I love the new report, a deep dive into kind of where we've been and where we're going. The Mid-Year Global Outlook, titled Getting a Grip on Global Uncertainty. So give me the key takeaway here, and ultimately, where does it leave BlackRock in terms of risk appetite for the second half of the year?
Yeah, so really it's been a volatile several years, I would say, actually, and that's something that investors are going to learn to have to live with. So the main point I think that we're trying to make through the outlook today is that we can't wait for a perfect world, whether that's kind of economic uncertainty, geopolitical uncertainty, domestic politics. We think it's going to continue to be volatile. That's something like a feature, not a bug, of the new economic and political regime. So as investors, we need to learn to live with that and invest in the here and now. We do think that has important consequences for how we invest, which is to say we think this is much more of a time for active. Back in the era that's popularly understood to be the Great Moderation, being kind of risk on, just in a very, very broad sense, it worked very, very well. But now we think in a world that's clearly kind of sadly fracturing and becoming much more complicated, we think it is necessary for investors to adopt a much more kind of active approach, being much more specific and targeted by asset class, geography or theme as to exactly where we want to have risk. To answer your question directly, Dan, we are still positive. So we're overweight US equities, a lot of kind of uncertainties around that. But overall, we think there are more tailwinds than headwinds, so active is really the message, but I guess we are a little bit bullish because the overweight US equities does stand out, I think.
Okay, so we're going to unpack the overweight. We'll unpack a few of the other investment trends that you're expecting to see in the second half. But Ben, let me get your reaction to what we've just seen unfold in the United States as well, because the president's been pushing this one big, beautiful bill past the Senate. It's now heading back to the House. What impact do you see for the US economy, and how consequential is this for global investors?
I think it's very consequential. So we're looking at a couple of aspects, I guess. One is the US administration. It needs to pass the House, as you rightly observed, Dan, but it seems like they're going to get this through after a lot of toing and froing, and that is, I suppose, a victory for the administration. So over the last couple of weeks, I think it's fair to say that President Trump and the US administration will feel that they've had kind of multiple wins domestically, foreign policy and otherwise. So I think that will feed through into confidence that they are on the right track. So again, as investors, I think we should very much expect to see a continuation of the, how can I say, more dynamic approach from this US administration, where comments can turn around kind of very quickly. Again, that's going to continue. So waiting for clarity, I think, is not an option. We're going to have to learn to accept that, deal with it, act and invest accordingly.
Do you think markets are underappreciating the trade and tariff risk right now?
A bit. I think what we've decided, we in markets have decided, is that there are really constraints, actually. So we believe, President Trump, we at BlackRock believe that the US are serious about trying to rewire global trading. That seems to be a real thing. However, they have to live in the real world, and there are something like laws of physics in the economic sense. You can't just click your fingers. Not even the mighty America can just click their fingers and kind of unpick 50 years of trade, globalization, and so forth. So it's going to take an awful long time, even if we believe, as I think we do at BlackRock, that there is a sincerity around changing the trading system. So these constraints slow the pace of change and mean that the US administration have to kind of deal with the world as it is. And that is somewhat reassuring. Again, we can't just move to a totally different paradigm. It's going to be slow. And the US administration, I think after Liberation Day, that was the key question. Are there any constraints on these guys, I suppose? And it feels like the answer is yes, actually there are. And markets have clearly, over the last several weeks, couple of months, found that really reassuring. Hopefully that continues.
Well, the reason I asked the question is because Fed Chair Powell also said that the Fed would have cut rates by now had it not been for Trump's trade and tariff agenda. What do you make of that, and what do you make of this battle brewing between the president and the Fed chair? Is it bad for business?
I don't think so, in the sense that the Fed is an independent institution. I think that's going to continue. President Trump's style, I think, is increasingly well understood by all participants in markets and society more broadly. So both of those are likely to continue and not overlap that much, perhaps. In fact, I don't think overlap at all in terms of directly impacting Fed policy over the next several months. So Chair Powell will continue to do what he does, which is to interpret data and changing data as that comes in. So for sure, moving from, let's say, the old administration to the new administration was an extremely relevant change of economic circumstances, and therefore Chair Powell needs to understand them as best he and the broad FOMC can, and then act accordingly. And for us, waiting and seeing a little bit was quite reasonable given the very high levels of uncertainty around April. I think Chair Powell now is becoming somewhat more confident, probably wants some more data through the summer, but it does feel like the Fed are warming up to make something of a move because they, like all of us, have to act under imperfect information. So at some stage they probably will get on with it, but not quite yet.
Okay, so let's bring it back to what all of this means for the investment strategy, because you say you're overweight US equities, of course, a big focus on AI. This is something that you and I have spoken about before as well. Do you think investors are overpaying for some of those US trades, though we're already seeing markets trade at quite a significant premium here, particularly in the AI space? So how do you navigate that?
So we would continue to be constructive, the AI megaforce, as we term it. So AI continues to be a revolutionary technology. We had a very interesting moment earlier in the year, the so-called DeepSeek moment, where the market was confused for a moment as to whether we needed both kind of lots of extra compute, or could we use the DeepSeek methodology of kind of using the pre-existing infrastructure more elegantly. And it seems like the answer is both. Right, so we need a more elegant approach to using the kind of data centers that are already there. That makes sense. But we also just need more. Both of those are going to continue. That means for us, the AI tailwinds will continue, not just in the big tech names, but also in the related kind of infrastructure, be that utilities, even the real estate, the physical data centers. So it's AI, but a kind of broad interpretation of AI, everything that goes into that. And our enthusiasm for the AI megaforce continues to be to continue.
As for Europe and Asia, where do we stand?
So a little bit mixed, I think. So again, I'd make the point around active, and we need to pick our spots a little bit. So in Asia, we continue to favour Japan. So Japan, we think, has a pleasing combination of, I guess, in the big picture, an astonishing turnaround in GDP, really flat for years and even decades. Now, with the return of inflation, you're seeing a much more kind of sustained growth in nominal GDP, which for equities is very good news. That's number one. Number two, the corporate reform story. I think it's been around for a long time. People are worried that it's sort of very slow moving. I think that's true, but it's real, and the urgency around it to drive corporate profitability, returns on equity, all of that stuff, we think is sincere, and there's more and more evidence of that coming through. So a particular kind of area we would highlight would be the Japan reform story, hence we're overweight Japan equities.
Europe?
So Europe, we are, like everyone, watching with great interest the fiscal revolution, I think we can say from the German perspective, where it feels like there is a particular catalyst around defence. It feels, again, like we're in a very different environment, geopolitical fracturing and so forth, where we're all going to have to look after ourselves a little bit more. That just seems to be true, and therefore Europe taking their defence spending up quite significantly. But that is feeding into a broader kind of fiscal growth story, which again seems to be real and does suggest a couple of things. One, a little bit more debt. So we worry a little bit about the term premium side of things, I guess, on the fixed income side. But on the equity side, clearly more growth would be beneficial. We'd want to pick our spots, favour Spain in particular. For now. So again, I'd make the active point that I'm making throughout this interview. But Europe, again, that growth story is something that's worth watching and could provide a potential tailwind for Europe, which has struggled for a few years in terms of the relative v the US.